Good afternoon. Time to have a look at the market's performance, starting off with the scene in the Asian region. Chinese markets fell as a lot of the investment banks are cutting their growth forecasts for the economy. In recent week, we've seen a lot of volatility with investors assessing monetary policy, inflation, as well as what China's strict COVID rules means for the global economy. Nonetheless, Hang Seng Index there down 1.75%, but also the Hang Seng Tech Index down 3%. And the Nikkei was in Japan down 0.9%. When we look at what's happening in Europe, European markets also in negative territory as that comeback rally that we were looking forward to seems to be out of reach at this particular point. But to give us more perspective, we are joined by Martin Smith, who is a portfolio manager at Anchor Capital. Martin, thank you so much for your time this afternoon. You have the Chinese authorities stepping forward and putting some tax relief measures in order to have some kind of impact on the Chinese economy that seems to be battling. And I'm wondering from your perspective how the market is reacting to these efforts.
Yeah, so you're absolutely right. They came out with some measures to help stabilize things, and they are quite material on face value, but the market seems to be adopting a wait-and-see approach to see how things actually transpire and how the rollout of these measures actually takes place. So it hasn't quite been captured in any kind of positive way, and in any instance, I think the market's just caught up in a lot of negative sentiment at the moment.
We've had about probably say 7 to 8 weeks of, volatility in the markets, and some analysts saying that it's really too soon to call a bottom. And I'm wondering, what are some of the questions you're asking yourself as you see the red screens, in the office?
So, I mean, you kind of get caught up a little bit in the emotional side of things. It has been playing out over a few months. So you do tend to ask yourself, is this different from the last time we saw markets go down and the time before that and the time before that? And the short answer is essentially it is the same. I mean, share prices will follow earnings over time. We are protected from a valuation perspective. S&P is now looking kind of average, or is trading in average kind of territory from a multiple perspective, and things will return to normal. The overhangs will pass. Hopefully inflation, we think, has peaked, will kind of normalize. So you ask yourself sometimes these questions to say, is this the same as last time, and will things recover? And again, the answer is it will recover. It will take time. But again, it's been, I think, emotionally taxing for investors and fund managers.
So yesterday we had earnings from Dis-Chem, and depending on who you speak to, some don't really want to touch Dis-Chem or Clicks because the perception is that they're expensive. So perhaps briefly, let's unpack why these two shares, although defensive, are quite expensive.
Expensive and defensive, absolutely. So, I mean, they've always been historically defensive and expensive because they've been growth stocks. So, Clicks, which kind of was essentially the first one out, they always delivered, have an incredible management team, always put the runs on the boards, always delivers, always gives you the growth that you're looking for. Foreigners love it. So, for those reasons, it has always traded at a historic premium to the other retailers out there. Dis-Chem's obviously also come on board. Traditionally wasn't as expensive as Clicks, but interestingly enough is now as expensive as Clicks, which is quite interesting. They haven't delivered quite as consistently as the management team of Clicks, but they've got a little bit more blue sky potential insofar as they've got more stores they can roll out. There's more Click stores out there than Dis-Chem, so that they can roll that out more. So there's more blue sky potential for them. So you're kind of essentially you're paying a high multiple because you're kind of getting solid earnings growth and solid management teams. But I don't know if I'd be rushing into them at the moment. I think there's good opportunities in some of the other retailers at more attractive multiples, specifically after the sell-off that we've seen in the last couple of weeks.
Right. In terms of events that you're keeping an eye on, what's on your radar for the week?
So, I mean, we've seen kind of the big things in the last couple of weeks. MPC, you've seen Fed numbers, you've seen US inflation numbers. So nothing kind of sticking out at the moment. I think it'll just be a general view on what's happening news-wise, COVID cases in China, anything else related to American GDP, Also talks of Trump's tariffs on China getting cut by the Biden administration. So I'll keep a close eye on that. But nothing kind of in the big monetary policy scheme of things. It's obviously coming out in a couple of weeks. So, yeah, just keeping a very close ear to the ground, I guess.
All right, Martin, let's leave it there. That is Martin Smith, who is a portfolio manager at Anchor Capital. Of course, we do have those FOMC minutes coming out tomorrow, which we will try and unpack them a little bit further for you on Thursday, as well as we look at other results out of the U.S. But that is it for me. We're going to take a quick break. When we come back,